Hello and welcome to another bonus episode of the 2021 Gold Summit. My guest here today was here at our last Gold Summit back in 2019. Is Ronald Peter Stöferle, who is the author of the annual In Gold We Trust report, which is essential reading for gold investors all around the world. He's also a fund manager over at Incrementum, which is based in Liechtenstein. He's a fascinating character, and I'm sure you'll enjoy this interview. Ronnie, thank you so much for joining me today.
Thank you very much. Thanks for having me. Good to see you.
Yeah, it's great to have you on again. It does feel like an awfully long time ago since we had our 2019 Gold Summit. Of course, we are doing it remotely this time around, but I have very much enjoyed been reading the In Gold We Trust 2021 report. Ronnie, there are a few themes I thought we could dwell on today. I thought the metaphor of monetary climate change was very stimulating indeed. Would you like to tell our viewers what is monetary climate change? What is going on at the moment, and what does this mean for gold?
Well, I think that the main topic of the report is the fact that central bankers keep telling us that inflation is now only temporarily or transitory, and that it will be that it's just because of the base effect and so on. But from our point of view, it is really a structural change that has happened. I think we're seeing a move from monetary dominance to fiscal dominance. We're seeing that nobody really takes care about or cares about budget deficits anymore. I think that politicians now really enjoy the fact that they will continue to manage or to micromanage the economy and inflation rates. So there are a couple of signs from our point of view that tell us, well, 2020 with the COVID crisis, that was really a big paradigm shift that has happened. And of course, now we're seeing inflation rates going in the direction that we have always expected. But again, people tell us it is only transitory, so relax. From our point of view, it is something that is structural, and it is, I mean, let's face it, it's exactly what politicians and central bankers want. They want higher inflation rates, and now they're getting it. So to quote Alanis Morissette, isn't it ironic? I think, we'll see if it will be easy to put the genie into the bottle again. I'm pretty concerned, I would say, that market participants at some point will realize that it is not transitory. They will realize that it has enormous effects on their asset allocation, because actually, over the last more than 40 years, nobody really experienced in the Western world or nobody navigated in an inflationary environment. So I think it will catch many investors on the wrong foot.
Right. And there are lots of aspects of that we could dwell on. I mean, is it mostly investors' allocation to bonds, you think, is one of their biggest mistakes, or their under allocation to gold?
Well, obviously, if inflation expectations aren't anchored anymore, and if inflation expectations also rise for the longer term, I would say that bonds aren't the very best investment at current prices, at least. And there is still 13 trillion invested in bonds at negative yields. So at some point, if our thesis is correct, there will be an exodus, huge outflows from those bonds. And I think this is really the main case for gold, but also for commodities. We crunched the numbers. We also did a special report on inflation. It was called "The Boy Who Cried Wolf."
Yeah.
You know this story, this fable by Aesop. And after the second time that he cried wolf, nobody trusted the shepherd anymore. And it is a bit similar, I think, with inflation. As we saw that 2008, 2009, many people were warning and scaring investors that hyperinflation is around the corner. But now it seems that it's really the real deal. And if you just compare 2008, 2009 to the current situation when it comes to monetary growth, back then we saw that it was only the monetary base that was going parabolic. But now we are also seeing broader monetary aggregates like M2, M3 rising at 25% plus. This is one of the main differences. Now, many people ask us, why didn't we see a major surge in inflation yet? And the answer is, well, velocity. Um, the whole world was basically in a shutdown. Nobody, um, uh, nobody did any bigger investments. We didn't see any capex. Nobody was able to make any plans. But now with the economies reopening and this confidence coming back, velocity has stabilized and is starting to rise, and this will meet a flood of liquidity that was created over the last couple of months. So I think this is really one of the main differences compared to 2008, 2009, and one of the main reasons why we now see that that people should really be concerned of rising inflation. And as we have crunched the numbers and read all sorts of academic papers about inflation and which assets do best in an inflationary environment, the answer is pretty easy. It is commodities and gold showing the highest inflation sensitivity and the highest inflation beta. So if you think, inflation might be around the corner, then why not invest in commodities and gold? And the market is already telling us, it is no coincidence that commodities are doing so well, that gold was up 25% last year and it is slightly up this year. So I think markets are already telling us, well, inflation is becoming a topic again. And probably they're also telling us that it's not transitory.
One thing you pointed to in your latest report, which I found very interesting, I'd actually forgotten it, right, was that 2021 will be the 50th anniversary of Nixon closing the gold window in the United States. It's only 2 months away now. It's going to be, the golden anniversary, as you say, of fiat money, very ironically. But when you're thinking of that monetary climate change dynamic, is the idea almost that the next 50 years we're going to see will be divergent from what we've seen over the last, say, 40 years. So the beginning of the 1970s, after Nixon did that, were of course very inflationary. But after Volcker showed up and killed the inflation, then it was a deflationary dynamic. And for a long time, we've heard the story that deflation is cooked into the cake because we've got debt, we've got demographics, and globalization bringing down costs like that. But the monetary climate change you describe is this is changing now, and it would seem very apropos if on the 50th anniversary this is when we're starting to see this grand change. I mean, going forward, Ronnie, the kind of world that you see we're approaching, I mean, is there a historical time period which you think would fit it very well? Would it be something like the 1970s or like the 1940s again, just with 21st century characteristics? Or are we coming into a new era that we don't really have a proper reference for?
That's a very good question. I think history rhymes, of course, and therefore we're making comparisons. For example, with the 1960s, first it was guns or butter, and then politicians decided, okay, let's go for guns and butter,
Right.
and so I think there are many analogies between the 1960s and the 1970s and the current environment. However, I would always be a bit hesitant to make just to base your assumptions on historic analogies.
Right.
However, I think that at the moment what we are seeing, you mentioned Paul Volcker, we're seeing some sort of a reverse Paul Volcker. Actually, Paul Volcker's job was to kill inflation. Now central bankers all over the globe keep telling us, well, we need more inflation, and they kept telling us that for the last couple of years. and the 3Ds that you mentioned. Of course, those are very, very strong deflationary triggers. We shouldn't forget that. And I think, the whole discussion, inflation versus deflation, is a very, very interesting one. And there's so many different aspects to consider. But I think that the deflationary forces are now getting weaker and weaker, while inflationary forces are getting stronger. So this is really like, let's compare it to a pendulum that is swinging into the direction of inflation.
Right.
And in the report, we listed the most important drivers for inflation now becoming stronger than deflationary factors. I've mentioned this reverse Paul Volcker, and I think it's no coincidence that since August last year, when the Federal Reserve made this big shift that was a bit underreported to average inflation targeting, I think since then, inflation expectations are already rising. Now, this basically tells us, as inflation rates were undershooting over the last couple of years, now the Federal Reserve has the leeway to let inflation rates overshoot. And I think this is really a big shift in central bank policy. And we will see something similar probably in the Eurozone. They're having some sort of a strategic decision to make, how to change their targets. But I think that some sort of average inflation targeting will be involved. So this is really a crucial thing to understand. But then we're also seeing that the role of central banks is shifting at the moment. While,
yes.
Back then, in German, we say Währungshüter, which means guardian of the currency. And I think we're completely moving away from that job description of a central bank. And now, if you read or if you listen to the speeches from central bankers, not only the Federal Reserve, but also the ECB and so on, it's much more about, the weather, basically fine-tuning or fighting climate change. It is more about inclusion. It's about social justice. So, I don't want to judge that, but I think as an observer, it's interesting to see this change in the job description that nobody really has, from my point of view, directed. So this is one important thing that we're seeing. And then we're seeing so many other different aspects that lead us to the conclusion that inflation is getting stronger now. We're seeing this some sort of Cold War 2.0. It is no coincidence that the last big summit between China and the US was in Alaska. I think we're seeing this trend to deglobalization. We are seeing lots of shortages in many industries, not only in the semiconductor industry, but also in many other industries. We're seeing demographics. Of course, it was a huge disinflationary driver over the last couple of decades, basically, with China opening up and the Eastern Europe opening up. That was a huge deflationary impact. This is now slowly but surely reversing. We're seeing things like ESG becoming more and more important. And of course, I mentioned this song by Alanis Morissette because I heard it this morning. It is probably pretty ironic that all those ESG measures will probably significantly positively impact the price of oil.
Yes.
I think I'm super bullish oil at the moment.
Yes.
And I don't know if that's really if it's an unintended consequence or if ESG activists are, if they really know what they're doing with their measures and activities. So I think it is many strong drivers for rising inflation, but we also know if financial markets sell off, if, for example, we see some sort of a new taper tantrum like in 2013, this would have a deflationary impact. But from my point of view, we are seeing that all taboos were broken last year.
Right.
We're seeing that, they crossed the Rubicon, and nobody seemed to care. So this is probably the how do you say, the in German we would say the Persilchen, the allowance to go ahead with those extreme measures in the next crisis. And of course, we're seeing this diminishing marginal utility. So we will need more and more, and 120 billion of QE per month won't be enough, and 2 trillion fiscal stimulus will also not be enough. But I think it would be naive to think that as soon as the S&P sells off, as soon as 10-year yields go above 2%, that we won't see any major interventions by central bankers and politicians.
Right. There are all manner of things that we could dwell on there, Ronnie. There's been there's a whole wealth of different aspects and sectors there. Well, on the ESG side, I think maybe a cynical person might argue that people who are really pushing the ESG policies would like oil prices to be higher, as that way it's easier to argue that renewable energy is more easy to transition to and things like that. There's one thing I'd like to dwell on, and this is me mostly playing devil's advocate here. So on the topic of central bankers changing their inflation targets, you point to the Federal Reserve changing their target to average inflation. So it will allow them to stimulate the economy and create more than 2% inflation over time, because they're just looking at an average rather than going for this year it's over 2%, therefore we need to hike rates or anything like that. One thing I would like to just as the sort of devil's advocate argument would be if central banks haven't been able to create inflation for not in CPI at least, not they've created asset price inflation, all these other strange and weird areas. But if they've not been able to create CPI inflation with the inflation target as it is, does this not really point to the fact that they're impotent in being able to create that? So changing the target won't actually aid that. I mean, I am playing devil's advocate here. I'm pretty confident central bankers, if they really want to, will be able to create that inflation. But how would you respond to that?
Well, I think it's a very, very important and central question to ask. But my reply would be that it is a process, and it's not like you just push a button and then inflation appears. And I think that the reason, or the fact that it didn't work yet is also the excuse to do more and more and more, and at some point something will happen. And therefore I think that I just criticize this hubris by central bankers that as soon as inflation rates rise too high, they will put the genie into the bottle again. Perhaps it will be the same like before, meaning that it just won't work, and they will have to do more and more and more, with the risk of crashing asset markets. And then, of course, this is where the big dilemma starts, because we know of the wealth effect, and the Federal Reserve continues to believe in the wealth effect. So basically, the higher the S&P rises, the higher real estate rises, the more people will spend, and the more upbeat they will be in their expectations and so on. And of course, if asset markets crash, it would mean that the Federal Reserve will have to step in again in an environment where inflation is still too high. So this is basically, there's no real way out of this trap. And we shouldn't forget that, like the normal toolbox of a central banker, the big tool was lowering interest rates.
Yep.
Now we already arrived at zero. Some countries, tried negative rates without a really big success. I could have told them so. And now, of course, they need new tools, and we're seeing, average inflation targeting, and this whole all those acronyms with new programs and so on. The Federal Reserve is now highly active in the corporate bond market, highly active in the real estate market. The Bank of Japan has basically taken control of the equity market. All things that one could question, of course. But from my point of view, the big new tool going forward will be yield curve control. And this is something that we have already seen in the past. And we should not forget that, now debt levels are the highest in peace times. And, everybody knows that we are seeing this over indebtedness, not only for governments, but also for many sectors. We're seeing it for private individuals, but we have seen even higher debt levels in war times. And therefore, we describe how this yield curve control was implemented after the Second World War in the US, but also in the UK. And it worked pretty well. Of course, being a bond investor, you didn't have
didn't work so well.
It didn't work that well. But I think, for the sake of simplicity, perhaps at 2% for US 10 years, this will be the level where yield curve control will start. And I don't know if it's going to be implicit or explicit.
Right.
But basically it could mean quantitative easing without any limits.
Yes.
And of course, I think this would be a tremendous environment for gold, because that's a guarantee that we will have negative real rates over the next couple of years, perhaps even decades. And as we have analyzed over the last couple of In Gold We Trust reports, if there's just one number, one statistic that really counts for gold, it is the absolute level, but also the direction of real rates. And from my point of view, it is pretty easy that we simply cannot afford positive real rates anymore. And in case the bond market should get nervous, at some point there will be yield curve control. And we saw it in March at 1.75 for the 10 years. Financial markets were really nervous already, and everybody was, those op-eds in the major newspapers. Everybody, it sounded like a little baby starting to cry, and daddy, mommy, I need you. All those very influential market participants, fund managers, economists, and so on, they said, well, we will have to implement some sort of yield curve control at some point. And I think this will be the next big tool for central banks. And, Australia has already implemented it.
Yep.
So this is happening.
Right. Yeah, on that note, Ronnie, when you're talking about the increasing role of central bankers, we've had the cult of the central banker for a very long time now. But when we're pushed to the limit where they need to create new, it's going to be a new acronym, and now we're thinking of literally just capping interest rates on government debt and printing as much money as is required to keep them capped at a nominal rate. And this is obviously a great time to be a gold investor. Real yields are, to my eyes at least, the most important number really when it comes to gold. And I don't really see how they can rise meaningfully, in order to bring the gold price down. But when central banks start doing this, it becomes an ever more political role. Something that something you've alluded to in your latest report on that. And as you said earlier, they've crossed the Rubicon. COVID gave them the excuse almost to just launch ever further forward and further clothe themselves in the robes of righteousness, as it were. We're saving the planet. Now they're all on about climate change and things like that. One thing that you pointed to also in your report was how symbolic it is that Christine Lagarde effectively openly endorsed a Green Party candidate in the German elections, which seems really, when it comes to central bankers playing in the political sphere, regardless of what your politics are, I just think just the fact that they are doing that is such a meaningful, it changes things entirely. And the whole point is that they're independent and that they are, as you would say, the guardians of the currency. We're just keeping everything ticking over. We're going to make sure there aren't any crises, et cetera, et cetera. And now here we are, moving ever further into that political space. Where do you think this is leading? Because to me, it's something I think it's really quite ominous. I get chills just sort of when you see these kind of stories, because they're moving into an area where really, social unrest, it becomes much more of a factor. It's almost like they become an almost Praetorian Guard sort of figure, where it's like, we back, the money printers are backing this candidate. Where do you think this is going? Because ultimately, central bankers have been assassinated in the past when things have gone wrong, when they've been blamed for doing the wrong thing. Do you think we're going to see this an awful lot more when central bankers are quite obviously leaning on the scales of politics?
Well, that's a big question, and I don't know if I have any good answer. I think the symbolic character of Janet Yellen now being the Treasury Secretary, I think this is, I couldn't believe my eyes when I saw that nomination. And I think that's no coincidence. And it's telling us that, a couple of quarters ago, perhaps, we saw this flirt between fiscal policy and monetary policy. But now this is really becoming one thing. And it's not only Janet Yellen, it's also Mario Draghi as the former head of the ECB, now being the prime minister in Italy. I think it is really, we're going more and more in the direction of some sort of a MMT policy. Because I think that for some reason, most people think that governments managed the crisis pretty well. I don't know why, but this is just a feeling that I get when I talk to people. For some reason, people think that capitalism is a thing of the past, while I would say, in most European countries, governments being responsible for more than 50% of GDP, I would question if that's real capitalism or if it's a quasi mixture of some capitalism and primarily socialism. But this is another discussion. But I think that MMT is really, it was just a theory from very left-wing economists before COVID, and now we're really now it's really center stage, and it's pretty well accepted. And we also saw that stuff like helicopter money and universal basic income, that's not a taboo anymore. This is something where most people say, well, sooner or later it's going to happen and it's going to be a good thing. So I think that capitalism is really in danger, and I think that this danger or threat got dramatically bigger over the last couple of quarters. And now we could say, well, COVID is over, we're going back to normal. I don't think so. I think that politicians, they enjoy having so much power. They enjoy that the dependency of companies and people on their measures, and they, therefore I think that it's something that confirms our view that we saw a shift over the last couple of quarters. And MMT Stephanie Kelton, I mean, it's not a conspiracy or anything, but Stephanie Kelton is one of the most influential advisors for Joe Biden. Um, she was, I think, she was the economic advisor for Bernie Sanders, and
That's true, yeah.
we know that Bernie Sanders is also very influential now. So I think, you know, MMT is here to stay. Um, you probably know that I'm a bit critical when it comes to those developments, but it is the zeitgeist, and you know, we'll have to live with that and make the best out of it. It doesn't make any sense to just criticize those developments all the time without doing anything. We got to make the best out of it, but it is definitely something that is changing the investment landscape.
Yeah, certainly, I agree. Coming to the events of the last couple of quarters, it would be remiss without mentioning Bitcoin and some of the craziness that's taken place there. There is, of course, while we are discussing gold here, Bitcoin has almost become part of the gold story, given the amount of coverage it gets, where gold and Bitcoin are apparently in competition with each other, and it's some winners take all contest. I don't agree with this thesis at all. I think they complement each other really quite well. What's your view? Because you guys at Incrementum have been covering the entire crypto landscape for some time now, and you do have some quite nuanced views when it comes to this.
Yes, I think that it's I just don't enjoy this discussion, gold versus Bitcoin, and that there's so much competition going on, and not competition, because competition obviously is something that I as a capitalist truly enjoy, and I think it makes everything better for the consumer. But this lack of, or this ignorance when it comes to Bitcoin from the people in the gold camp, but also, you know, people in the Bitcoin camp saying, you know, gold is a thing of the past, and you know, you've got no idea of the future. I think the lack of discussion and exchange between two camps is something that worries me quite a lot, and we all know that everybody wants or needs to have an opinion on gold. So nobody does not care about gold, while, you know, if I ask people, what's your view on convertible bonds, most people will say, well, I don't care. But everybody has to share something when it comes to gold.
Right, yeah.
And with Bitcoin, it is, you know, the narrative at the beginning was, well, we're going to change our monetary system. Then the narrative was, well, this is only for illegal activities, Silk Road and whatever. And now the new negative narrative is that it's so bad for the environment. And I think that what we saw over the last couple of months, of course, we saw, let's say, bubbly developments. But we also have to say that quite a lot happened over the last 10 years. And I'm following Bitcoin really for quite a while now. And we have two funds that combine physical gold with Bitcoin. We've got a fund that combines Bitcoin and other cryptocurrencies from the DeFi space with mining equities, with gold and with silver. So we think, as you've said, it's complementary. But I think that many people in the financial market sector really woke up last year. And I think that Bitcoin is now really, it has grown up. We're seeing it in regards of the infrastructure, for example. In one of the funds we manage, we make use of this enormous volatility of Bitcoin. And actually, you know, events like over the last couple of weeks, they're terrific, because we can write options on Bitcoin at implied vols of 180%. It's ridiculous.
Right.
So, but only since the beginning of last year, we are seeing an options market. And at the beginning, I think we were responsible for quite a lot of trades in this option market. But now this is really growing. We're seeing a futures market. We're seeing more and more established players, you know, the likes of Fidelity, Mass Mutual, many family offices, high net worth individuals now really accepting the fact that it is not only a bubble or a crazy money, that there is more behind. And I'm meeting quite a lot, or usually meeting quite a lot of people at conferences in person, and I think I've met some of the most brilliant people, the most ambitious, smart, entrepreneurial people in the crypto space. And I think, many projects will go bust and they're useless. But I think, all the developments that we're seeing in decentralized finance, many blockchain applications will really change the world. And it would be naive to think, if you're from the gold camp, that this is just another bubble. However, as I've said before, I think it's Bitcoin to some degree also tries to replicate physical gold. It's no coincidence that the stock to flow ratio is so important for gold. At the moment, they have roughly the same inflation rate at 1.5, 1.6%. With Bitcoin, of course, it's decreasing. I think there's many analogies, and therefore everybody trying to make a competition between the two. I would say, well, you can drive a super safe Volvo SUV, and it's safe, and you will get from A to B without any problems probably. Or you could also take a Ducati Panigale with 140 horsepower. It is more riskier, but you will be there faster. But if it starts raining, for example, of course it's a different risk profile. So long story short, I like both, but of course gold has a significantly higher market cap. It's at the moment probably 15 times higher. It has a significantly higher track record than Bitcoin, and this explains this risk profile. So we like gold for stability, and Bitcoin and cryptos in general for convexity.
Right. Yeah, I think I agree. Very much with that kind of sentiment when it comes to how they complement each other and how they can fit into a portfolio in different ways. Ronnie, I do understand that you are very short for time at the moment, so we shall wrap this up shortly. But one last thing. One of the favorite parts for me in the In Gold We Trust report is the annual update on the gold to beer ratio, which came in very bullish, I think, on the gold beer ratio this year. It has seen quite an uptick, but we've yet to see anything like 1980. On that note, and also when it comes to your broad projections for gold, I was interested to see amongst your predictions for where the gold price will be by 2030. I think it was 19.6% for a gold price between $4,000 and $5,000, with a conservative sort of inflationary expectation, putting it about $4,800. Would you like to just in short, would you like to sum up what sort of led you to that figure, and just how you got there and what it is that you're expecting?
Yeah, well, we introduced our long-term pricing model for gold last year, and we updated it this year, and it says that $4,800 at the end of this decade is the conservative assumption. That sounds like a lot, but that's an annual rate of return of roughly 10%. So we're broadly in line. And coming back to beer, we just like those comparisons, those long-term comparisons, to show how gold really preserves your purchasing power. This is the role of gold. It won't make you super rich, but it will protect your savings. It will protect your purchasing power. That's the role of gold, like a good defender in your team, or a good goalkeeper. And with the gold Oktoberfest ratio, you can see that your purchasing power measured in mass beer, those 1 liter max, is fairly stable, while we are seeing price increases between 4 to 6% every year at the Oktoberfest. Of course, this year, unfortunately, again, it will not happen. But you can see that compared to fiat money, the purchasing power is highly stable. At the moment, it's slightly above long-term average. So that means gold isn't super cheap, but it's also not super expensive. And this year, we introduced our readers to a new pricing model, which is based on the options market, and it tells us, or the options market is basically discounting that the chances for a new 52-week high, which would also imply a new all-time high, is significantly higher than a 52-week low. So,
Right.
so this basically confirms our view. We would see gold this year trading at around $2,200 by the end of the year. But I think the most important takeaway really is gold is in a bull market. I think gold really delivered last year. It exactly did what it has to do. It was up 25% in dollar terms. It was up 15% in euro terms. It was up in every currency. We really see that due to the enormous debt piles that we're having now, chances for rising real rates are probably lower than ever. And this is really the foundation of this gold bull market. And therefore, I think that those $4,800 sound like a lot, but to me, this is pretty realistic. And, who would have expected in 1971 that only 9 years later, the price of gold would be at 850? That would have really been a outrageous forecast. And from my point of view, due to the whole macro picture and due to the fact that inflation is now reappearing, I'm pretty confident that we'll reach those price levels.
Well, Ronnie, I'll let you go there. You're a man in very high demand at the moment. Thank you so much for joining me today. And thank you also for writing the In Gold We Trust report. It is a great read every year. Very much enjoy reading it. And of course, it is available for free, which is even better. But Ronnie, thank you so much. This has been great.
Thank you very much, Boaz. I really, really enjoyed it. All the best. And yeah, see you probably next year at the latest.
Yeah.
Take care. Thanks.
Bye-bye. Well, there you have it, folks. That was Ronald Peter Stöferle, the author of In Gold We Trust and the fund manager at Incrementum. I hope you enjoyed that conversation as much as I did, and I also hope you take a read of the In Gold We Trust report, which is now fresh off the presses. There'll be a link to it in the email that accompanied this video. I do highly recommend the full 300-page version if you do want the full gold investing experience. It is very rich with charts and other data, and some great quotes indeed from gold investors, including some which you may be familiar with from the Gold Summit. That's all from me for now. We shall see you next time.